A. Explanation of what it means to buy a business. Buying a business refers to the process of acquiring an existing company or enterprise, rather than starting a new business from scratch. This can involve purchasing the assets or shares of the company and taking over ownership and control of the business. B. Brief explanation of the pros and cons. Buying a business can offer many advantages, such as an established customer base, existing operations, brand and reputation, experienced staff, and potential for immediate profit. However, there are also potential downsides, such as high upfront costs, hidden liabilities, negative reputation, difficulty changing existing processes, and dependence on existing staff. C. Preview of the main points to be covered. In this video, we will explore the pros and cons of buying a business in more detail, including the importance of due diligence when considering a purchase. We will also discuss what to look for during due diligence, including financials, legal issues, operational procedures, reputation, and staff. By the end of this video, you will have a better understanding of whether buying a business is the right choice for you, and how to go about making an informed decision. Pros of buying a business. A. Established customer base. When you buy an existing business, you inherit an established customer base that has already been developed by the previous owner. This can save you a significant amount of time and resources that would otherwise be required to attract and build a customer base from scratch. With an existing customer base, you can hit the ground running and start generating revenue immediately. B. Existing business operations. One of the biggest advantages of buying a business is that you don't need to start from scratch. All the systems, processes, and procedures have already been established by the previous owner. This means you can avoid the steep learning curve that comes with starting a new business and focus on improving and expanding the existing operations. C. Established brand and reputation. An established business has already built a brand and reputation in the market. This can be a valuable asset, as it provides a level of recognition and trust with customers that would otherwise take a long time to build. With an established brand and reputation, you can easily differentiate yourself from competitors and attract more customers. D. Access to experienced staff. When you buy a business, you also acquire the staff that comes with it. This means you have access to experienced and trained employees who can help you run the business effectively. This can be particularly beneficial if you are new to the industry or lack specific skills and expertise. E. Potential for immediate profit. One of the most attractive aspects of buying a business is the potential for immediate profit. Unlike starting a new business, where it can take months or even years to turn a profit, an established business already has a revenue stream. With the right management and improvements, you can increase profitability and generate income from day one. Overall, buying a business can offer a range of benefits that can help you start and grow your business more quickly and effectively. However, it's important to weigh these benefits against the potential risks and downsides before making a final decision. Cons of buying a business. A. High upfront costs. One of the main disadvantages of buying a business is the high upfront costs involved. Purchasing an existing business can be expensive, especially if it's a profitable and established business. You may need to secure financing or take on debt to cover the purchase price, which can put a strain on your personal finances and limit your options in the future. B. Potential hidden liabilities. When you buy a business, you also inherit any existing liabilities that the previous owner may have had. This can include legal, financial, or operational issues that may not be immediately apparent during the due diligence process. Hidden liabilities can be costly and time-consuming to address, and can negatively impact your profitability and reputation. C. Existing negative reputation. While an established brand and reputation can be a benefit of buying a business, it can also be a disadvantage if the business has a negative reputation in the market. If the business has a history of poor customer service, product quality, or unethical practices, it can be difficult to overcome this negative perception and rebuild trust with customers. D. Difficulty changing existing processes. When you buy an existing business, you may find that some of the existing processes, systems, and procedures are outdated or inefficient. However, changing these processes can be difficult, as it may require significant time, resources, and staff buy-in. It can also be challenging to strike the right balance between preserving what's working and implementing necessary changes. E. Dependence on existing staff. While having access to experienced staff can be a benefit of buying a business, it can also be a disadvantage if you become too dependent on these employees. If key staff members leave or retire, you may find it difficult to replace them or continue operating the business effectively. Additionally, existing staff may be resistant to change or new management, which can hinder your ability to make necessary improvements. Overall, while there are many benefits to buying a business, it's important to carefully consider the potential downsides and risks before making a decision. Thorough due diligence, proper planning, and a willingness to adapt and make changes can help mitigate these risks and increase your chances of success. Due diligence. A. Explanation of the importance of due diligence. Due diligence is a crucial step in the process of buying a business, as it involves thoroughly researching and evaluating the business to ensure that it is a sound investment. This process helps identify potential risks and issues that may impact the value and profitability of the business, and allows you to make an informed decision about whether to move forward with the purchase. B. What to look for during due diligence. During due diligence, it's important to look for a range of factors that may impact the business's value and viability. These can include financials. 1. One of the most important factors to consider during due diligence is the financial health of the business. 1. This includes reviewing financial statements, tax returns, and other financial records to ensure that the business is profitable, has positive cash flow, and does not have any outstanding debts or financial liabilities. Legal issues. 1. Another important area to investigate is any potential legal issues or liabilities that the business may have. 1. This can include reviewing contracts, leases, and other legal agreements, as well as investigating any past or pending lawsuits or regulatory issues. Operational procedures. 1. It's also important to evaluate the existing operational procedures of the business, including its production processes, supply chain management, and customer service protocols. 1. This can help identify any inefficiencies or areas for improvement, as well as any potential operational risks or challenges. Reputation. 1. The reputation of the business is also an important factor to consider during due diligence. 1. This can include reviewing customer reviews, social media presence, and any other public feedback or commentary about the business. 1. A negative reputation can be difficult to overcome and may impact the business's value and profitability. Staff. 1. Finally, it's important to evaluate the existing staff and management team of the business. 1. This can include assessing their experience, skill sets, and overall performance, as well as identifying any potential retention risks or issues. By thoroughly evaluating these factors and conducting due diligence, you can gain a better understanding of the risks and potential value of the business, and make an informed decision about whether to move forward with the purchase. A. Recap of the pros and cons. Buying a business can offer a range of benefits, including an established customer base, existing operations, and potential for immediate profit. However, it also comes with potential downsides, such as high upfront costs, hidden liabilities, and dependence on existing staff. It's important to carefully consider these factors before making a decision to buy a business. B. Explanation that buying a business is not for everyone. It's important to note that buying a business is not the right choice for everyone. It requires a significant investment of time, money, and effort, and comes with inherent risks and challenges. It's important to carefully evaluate your goals, skills, and resources before deciding whether to pursue this option. C. Final thoughts on the matter. While buying a business can be a challenging and complex process, it can also be a rewarding and lucrative investment for those who are willing to put in the work. Thorough due diligence, careful planning, and a willingness to adapt and make changes can help mitigate the risks and increase your chances of success. Ultimately, it's important to approach the decision with a clear understanding of the potential pros and cons, and a realistic assessment of your own capabilities and goals.